We got another day here with the market dropping even further, which I know nobody's used to after this big run up, but this is normal. And I'm actually looking forward to a bit of a correction because it lets us reset. So in this video, like we do almost every week, we're going to talk about what's happening in the market and where prices are going to head from here. Is a crash coming or are we safe? And to do it, we're going to head over to Macro Ops to check out the latest research. And we'll start with a quote again. There's no asset class too much money won't spoil. And that's from Barton Biggs, who's written a bunch of books on hedge funds and investing. Really solid if you haven't read them. And to me, this quote really makes sense within the context of the markets we've been seeing. Just non-stop buying, especially in tech. You look at this action and you would have never thought there was anything wrong with the economy. What pandemic? But when you have so much money flowing into these stocks, eventually they're going to take a break, which is what's happening now. And as I said, I'm looking forward to it because in the fallible strategy, we're 85% cash right now. And the reason we have such heavy cash positions is because we've been selling on the way up here. That's why you take profits. So when stocks started dropping this month, we've been safe for most of it. And by the way, if you want more details about the strategy I'm talking about and the fallible portfolio, definitely check out this free training. We show you everything you need to be able to execute this strategy yourself. There's a link in this video and down below in the description and comments. And like I said, it's free, so you might as well check it out. We're up over 50% this year. And as I was saying, we haven't taken much losses on this down move. And as of this recording, we're down almost 10%. So one of the reasons is because of that profit taking on the way up, which is so important, and I always talk about it because of times like this. Well, if you've taken most of your profits when things are good, you don't have to give back all that money when things turn around. That's the point of profit taking. And I know when you sell shares and the market keeps shooting higher, you feel bad. You think, man, I shouldn't have done that. I should have stayed in because I would have had this many more dollars. But that's the type of emotional stuff you got to throw out because you're supposed to take profits during the good times. And that's what actually reduces your exposure and your risk when the market finally does turn around, because you don't know exactly when it's going to. No one does. So for example, the strategy we used did not predict that the market was going to fall in September. And it doesn't need to, because by this point we had light exposure, so we're not losing. And now, because we took so many profits, we have a lot of dry powder left over. And by dry powder, I mean cash. We're ready to deploy again. And it's nice being in cash while things are falling because you know the market is going to take a break. And if you're long-term bullish, like we still are, then eventually, once again, it's going to turn around and go higher. So people have been asking me what type of correction I think this will be. Well, I think it's going to be a minor correction between 10 and 20%, and that the bull is going to continue higher. And we're going to go into more data in this video explaining why. But if that's the case, then yeah, it's awesome when the market goes down and you could buy at lower prices. And I'm not talking about a buy the dip strategy here because I think that's just stupid unless you have some real knowledge behind it. I'm talking about continuing to execute whatever strategy you're using. So for us in our strategy, we'll have a new rotation on October 1st, where we'll deploy a bit more money into the market. And our strategy focuses on NASDAQ stocks, so I should be looking at this right now. Now, do I know for sure that the market's going to turn around on October 1st as soon as I put my money in? No, of course not. That's why the other part of risk control beyond just taking profits is cutting your losses. So on September 1st right here, we did the same thing. We bought into a few positions. Now, we didn't exactly lose on those positions, but they did turn around and head lower to the point where we had to sell them. And the two that we got out of this month were pretty much break even, which is completely fine. And I'm happy that we got out because look what happened since we've sold. We sold in the first few days of September. One of them was DocuSign, which we sold in the first few days. And that just continued to drop. So anyway, like I said, we had that dry powder. The lower the market goes, the better for us really, because we're ready to deploy when it turns around again. This is a healthy correction that's happening. And you can learn more about everything I'm talking about in this training. So one thing we always love to do is measure the sentiment in the market. And the Bank of America Global Fund Manager Survey helps us do that. So here's a few highlights from that survey. 58% of investors say a new bull market has begun. And that's up from 25% in May. So people are pretty bullish. And I wouldn't say they're overly bullish, just 58%. So we're still safe from that regard. But the idea with sentiment is if people are way too bullish, it's actually a bearish sign because everybody's invested if they're all bullish. And then what can they do from that point? They can only sell. Versus the opposite, when everyone's super bearish, that's a bullish sign because there's a wall of worry for the market to climb. And a lot of people can still put their money in, which we're about to discuss. A huge group of those people still haven't put their money in. And these are the big whales, the big boys. Dry powder cash levels rose from 4.6 to 4.8%. So they're saying below 4% is greedy and above 5% is fearful. So we're right in that mid range right now. Not too bullish, not too bearish. We're paranoid tech. Long US tech is the most crowded trade of all time. That's what I mentioned before, going back to this quote, right? There's no asset class too much money won't spoil. And that's just the pendulum of markets. Everybody's in tech. Seems like a very simple trade, right? We're all stuck at home. Everyone's working remotely. Tech are the stocks that are going to keep going higher. But if everyone's thinking that, you should be looking the other way. Or at least if someone yells fire in the crowded movie theater, you want to be first out the door. Now, contrarian trades all fall into UK stocks, energy, and banks. If you're buying those, you're a contrarian. And when it comes to US tech and healthcare, and discretionary, if you're shorting those, then you're contrarian. So everybody else is long. So you can see it right here. Most people are very bearish on Japan, staples, banks, energy, and UK. In Japan, if you've been looking at the news, that's where Buffett has been looking a bit too. And you know everybody loves to know exactly what Buffett is doing. And when you think about markets, they're just a pendulum swinging from one extreme to another. So this is a chart showing how many barrels of oil one share of the SPY ETF can buy. So back in the tech bubble, it could buy 10 barrels of oil. In the bottom in 2008, 2009, 1 barrel of oil. Now we're back up to 8 barrels again. So if you thought the market was efficient in any way, it's not. It's a lot of emotions swinging back and forth. Prices get way out of bounds. And I'm not saying that's a bad thing about markets. You just need to accept it and know how to play it. Which is why I always laugh at people saying, oh, the valuations are too high. Well, they could get higher. What's the quote? The markets can stay irrational far longer than you could stay solvent. So really, you got to accept that it is a pendulum and play it for one. Now, like I was saying before, there is a large group of investors that haven't invested in the market yet. Now, when you think about retail and small funds, they are extremely long. We got retail buying nickel as it becomes more and more of a fraud. But the large institutions and the hedge funds, they've missed out on this huge rally from the March lows. So they have tons and tons of cash sitting on the sideline. So the UBS research shows that US active fund positioning is 1.8 standard deviations below average. Cash levels are still elevated. So institutional money market flows tend to follow the Fed rate with a 1-year lag. So meaning when institutions are putting their money in more fixed income things like the money market, they'll usually change that allocation if rates are too low because they're not going to get anything. So that cut to zero that the Fed made earlier this year should mean more cash flows will be coming to equities over the coming months. Because if you can't keep it in bonds, where you got to put it in stocks so you could get some type of return. So cash levels are supportive at levels as a percentage of equity plus bond market cap not seen since 2012. Basically saying lots and lots of cash. So this is one of the many reasons why this downside in the equity markets is likely limited over the short term, and the longer term path of least resistance remains up. So that's what I was saying about this correction. Okay, maybe 10 to 20%, but the longer term bull market is still intact. And these guys, these institutions and hedge funds, when they put their money in, it is going to move the market. There's billions and billions and billions of dollars. These are the big guys, so they can push the market higher. One key factor to look at when you're trying to analyze the stock market is buybacks. And buybacks are what? Just companies buying back their own shares. You wouldn't think they were that important, but they actually are, because they prop up the market a lot. And buybacks are supported by free cash flows and cheap debt. And this year, companies have barely been buying back their own stock. But as you can see here with this blue line, free cash flow for all these companies is jumping. So it's up 20% year over year. And if buybacks are supported by this free cash flow, including cheap debt, which you know we already have, then we should see this trend reverse over the next 2 quarters, meaning we should be getting some buybacks soon. And that once again will push this market higher. So just another reason why we're still long-term bulls. Here's another interesting chart if you want to look at demographics. Here you can compare 35 to 55-year-olds, their population growth versus 65 plus. So you can see the retirees are this brown line and their population is pretty much peaked. Whereas the people in the 35 to 55-year-old range, they're just starting to grow. And these guys, the younger guys, are the ones that are going to hold more equities, because the retiree people are going to start rotating out of equities and into more safe assets like bonds, which might be a little different this time because we know bonds aren't giving any returns. Interest rates are so low. So you might see these older people still going long Apple, long into retirement. But in addition to that, these people that are coming of age, they start collecting a good amount of money after working for a number of years, and all that is going into the market. Here's a chart showing their relative performance between small caps versus the S&P 500 dividend yield, that's the blue line, and then the same performance in price. You can see they're pretty much inversely related. So if this is any indicator of things to come, we might see small caps really take off versus these larger caps. Value stocks had their best month since 2001 versus growth, and small cap value is a great place to look right now if you're looking for stocks. Based off this and a bunch of other factors, they should materially outperform over the coming quarters. But it doesn't look like we're going to see a secular turning point in the whole growth versus value debate, because for that to happen, you would need a jump in inflation and a steepening of the curve. But we know we're not seeing that. So if we don't see that, you know, people are still going to be piling all their money into the big names, and we'll continue to see what we've been seeing here. A lot of these value plays that we're talking about are actually dependent on rising commodity prices, and commodity prices are dependent on the dollar, and the dollar is looking like it's going to trade lower over the coming years. Big part of how you analyze the dollar is comparing the US equity market to the rest of the world. And right now, US stocks are at an all-time high as a share of the global index. And what do we know about markets? Like we just discussed, when things go too far in one direction, correction, they'll eventually turn around. So if money starts flowing back outside of the US, outside of the US stock market, then people don't need dollars as much anymore, do they? So people will be getting rid of their dollars and the dollar itself will trade lower. Relative growth is another factor that goes into this as well. How is the US growing compared to the rest of the world? And right now, growth in the rest of the world is picking up compared to the US, meaning there should be a weaker dollar in the medium term. But what's interesting is that CCPV trends are much worse in Europe than they are in the US. So we'll have to watch to see if that does affect the dollar. More people flooding into here where things are safer. Now, if we go back to the charts, we could look at this on a monthly basis. And you can see we had very strong monthly closes for the past 5 months. There's 8 trading days left in this month as of this recording, and you can see that we're posting a real nice and fat red bar. If we continue to head lower and this bar closes near its lows, then that increases the odds of more downside in October. But again, it should be limited based off this trend of all these strong bars. The trend is still up. And the reason we look at these monthly bars is because they're so long term that they give some of the best signals. The shorter you go in time frame, the more noise you're gonna see. So if you're really trying to look for a trend, the monthly charts are a good way to do it. So we monitor how things close. Other than that, the narrative that the Fed is gonna keep printing money and not let the market fall is consensus. Sentiment and positioning are headwinds and sources of trend fragility. Like I said, people are still a little too bullish. But the large asset managers still have a ton of cash on the sidelines. They are not invested in the market like they should be. So cash on the sidelines means that they're ready to buy into any sell-offs, which is why we don't think the downside is that bad. Market breadth doesn't look great, probably lead to more weakness, but it's not bad enough to indicate a huge sell-off or anything. Macro and liquidity conditions are still flush and rebounding, but yields are starting to rise and credit spreads do not look good. So they are signaling weakness in stocks over the short term. So once again, to sum it up, yeah, it does look like a short-term correction, but the overall bull market is not dead. It's very much alive. There's a lot of money left to come into this market. So once again, you should be thinking about protecting your profits and making sure you have that dry powder for when the market turns around. You're going to get opportunities to get into these stocks at much better prices and at the bottom of the trend when it's about to resume. And if you want to see how we do all of that, definitely check out this free training that teaches you how we do it. It shows you our strategy. It's free and there's a link in this video and down below in the description comments. So check out the training and make sure you subscribe to this channel if you haven't already, because we got more market reviews coming every week. Do those things and I will see you in the next video. Stay fallible out there. Bye.